So it's a nice time we meet for a session of advanced financial reporting. So today we are going to talk about earnings per share. So this is a topic that is under International Accounting Standards 33. So it's under IAS 33. So under this topic anyway, it's only that you need to understand what you are supposed to do. Because now at the same time, if it's examinable, the main thing is, will you be able to do what they will examine you? So when we talk about earnings per share, so you need to understand two things: how to compute basic earnings per share and how to do diluted earnings per share. So the two of them. So the basic earnings per share and the diluted earnings per share. So for today, to start with, I will start with the basic earnings per share. So when we talk about basic earnings per share, we always say that generally we always take the profit attributable to ordinary shareholders. We divide with the weighted number of ordinary shares. So that is all about the basic earnings per share. So on how to compute that, it's only that you take the profit attributable to ordinary shareholders, you divide with the weighted average number of ordinary shares. So generally under EPS, we always say that EPS is the profit attributable to ordinary shareholders. The profit attributable to ordinary shareholders at the end of each reporting period. So which I have said, we have two types of EPS. That is the basic EPS and the diluted. So to start with, I have said how to do basic EPS, which is the profit attributable to ordinary shareholders. We divide with the weighted average number of ordinary shares. So whereby, in order to determine this aspect of the basic, not the basic, but the profit attributable to ordinary shareholders, the profit attributable to ordinary shareholders, we always start from the reported profit after tax. So because I've said for basic earnings per share, it's only that we take the profit attributable to ordinary shareholders divided by with the weighted average number of ordinary shares. So this aspect of profit attributable to ordinary shareholders, which I call it PAUS. How do you determine that? Because in short, basic earnings per share is PAUS, you divide with 1/nose. So how do you get the PAUS? So to get the PAUS, you start from the reported profit after tax. So after the reported profit after tax, you are supposed to raise the profit attributable to non-controlling interest. After the profit attributable to the non-controlling interest, you are supposed to subtract the preference dividend. You subtract the preference dividend. Then finally, you are supposed to add or subtract extraordinary items. So the extraordinary items. Then what about now the 1/nose? The weighted average number of ordinary shares. So the weighted average number of ordinary shares. So these are about the number of ordinary shares weighted for time factor. The number of ordinary shares weighted for time factor. So that to make you understand very well about this aspect of to make this topic become more interesting, I will be able to share some of the notes here so that we go through, because I understand that most of the students like seeing the materials as I explain. That one can be more better. So these are some of the notes I will share with you. So we say that EPS is the profit attributable to ordinary shareholders at the end of each reporting period. So we have talked about types of EPS: basic EPS and the diluted EPS. So the basic EPS is the PAUS you divide with 1/nose. PAUS is the profit attributable to ordinary shareholders. Then the 1/nose is the weighted average number of ordinary shares. So that is what I was saying, that how do you get now the PAUS? So to get the PAUS, you start from the reported profit after tax. So after the reported profit after tax, you are supposed to subtract the profit attributable to NCI. The profit attributable to NCI. That is the profit attributable to NCI. So after this profit attributable to NCI, remember that now you have again to check if there were some dividends which were attributable, the dividends which were attributable to the preference shareholders. So you subtract that, so the preference dividends. Then after the preference dividends, you add or you subtract extraordinary items. You add or you subtract the extraordinary items. Then what about the one-offs? What about the one-offs? So the one-offs is all about the number of ordinary shares weighted for time factor. The number of ordinary shares weighted for time factor. So let's say, for example, now, in this financial year 2021, there's a company A which was having an outstanding shares. So let's say 200,000 outstanding ordinary shares. So coming to July, this entity issued 50,000 ordinary shares to its relevant shareholders. So then now you are asked to do the one-offs on this case. So what you always do is that, remember the 200,000, the shares which were outstanding from January. That one you wait for 12 months. So you say 200,000 times 12 over 12, because now the 200 was outstanding for the entire period. Then the one which were issued now July, you consider from that time July to the end of the year. So let's say, for example, 6 months. So you take 50,000, that is the ordinary shares, you multiply with 6 months. It's from July to the end of the year. You add with your 200,000, because now 200,000 was outstanding for the entire period, 12 out of 12. That is the case you do. So one knows the weighted average number of ordinary shares is all about you weigh the shares. So the number of ordinary shares weighted for time factor. So the number of ordinary shares weighted for time factor. Then under this EPS, there's this main thing you need to know. There's many other things, but there's main thing you need to understand when it's incorporated in a question. So the aspect of issue of shares without a corresponding change in resources. So on which scenarios organization can issue shares without getting an equal return? On which scenario? This is a question to you. On which scenario an organization can issue shares without getting an equal return from the shares it issued? An example? Isabella and Adrian. On which scenario an organization can issue shares without getting an equal return? So one of the answers was displayed in the screen. You cannot mention even that one. So there's this aspect of a bonus issue. There's this aspect of right issue. Then there's this aspect of share split. And again, there's this aspect of reverse split. So we always say that bonus issue is whereby an entity issues shares to the existing shareholders for free. That is at no consideration. So the entity giving out shares to the existing shareholders, but for free. So which I mean at no consideration. So on this scenario, you can see that the organization is doing what? The organization is issuing shares But now the amount it's getting in return is not equal. The amount it's getting in return is not equal at all. Because now if it gives out a bonus, that is a case whereby, yes, it was giving shares to the existing shareholders at no consideration on a certain proportion. For example, now for every 3 shares you have, you are given 1 for free. So for every 3, you are given 1. So it will consider all the shares you have. Then now you cross multiply, you determine the bonus you receive. But now the organization was not getting any equal return to you. So on this case, when there's a bonus issue, remember that it was shares which were issued. So the bonus must affect our one-nos, the weighted average number of ordinary shares. Because under this scenario, under the one-nos, is whereby we have said, in determining the one-nos, we always weigh the number of ordinary shares as per the time factor. So we weigh the number of ordinary shares. So since there is now these shares which were issued for free, obvious, you need to know how to deal with that aspect of these shares which were issued for free. Then another aspect whereby an organization can issue its shares without getting an equal return is the aspect when there is a right issue. So who can try? What is a right issue? What is a right issue? Someone? Isabella, what's a right issue?
A company issuing shares to the existing members on lower prices than the fair value price.
Yes, at a lower value. So the way one of our students has said, the right issue is whereby the entity issues shares to the existing shareholders at the lower value. Let's say now, at a certain value than the existing market price. So that is what I was saying. That let's say, for example, the market price was shillings 20. So the organization can accept to give shares to the existing shareholders at 15. So it has given out shares to the existing shareholders at a lower price than the existing market price. And that is what we call a right issue. And it must be on a certain proportion. So giving out shares to the existing shareholders at a lower value than the existing market price. So on a certain proportion. So on this scenario again, remember that it's shares which were issued. And to be more specific, it's the ordinary shares. So when you will be doing your one-nos, the weighted average number of ordinary shares, under this scenario, there's a formula you have to use. So to determine your one-nos, there's a formula which is applicable. And which is this formula which is applicable? So let us check. So this is the formula which is applicable when there's an aspect of right issue and you want to determine the one-ons. So the one-ons will be the ordinary share before right issue. You multiply the fair value before the right issue. You divide with the theoretical ex-right price. You multiply with the period before right issue. Then you add ordinary shares after right issue. Then you multiply with the period after the right issue. So that is the case whereby you have a right issue in a question. So this is the formula you use to determine your one-nos, the weighted average number of ordinary shares. Then the next thing, whereby again we can have an aspect whereby the organization is dealing with shares, but now the resources it's getting in return is not equal, is whereby we have a share split and a reverse split. So a share split involves reduction of the par value of the outstanding ordinary shares. So we reduce the par value. And the main objective of doing this is to make the shares more affordable. To make the shares more affordable. to the investors, to make the shares more affordable to investors. Then the aspect of reverse split involves now increasing the par value of ordinary shares. And the main objective of doing that is to make the shares expensive to avoid dilution effect. So whereby you reverse now, you increase the par value so that you would avoid the aspect of your shares becoming valueless. That is the aspect of making them expensive to avoid the dilution effect. So in any question you will be doing, in a nutshell, what we have done, that is in a nutshell, what we have done is just, I have just compressed these materials for EPS because now I could have done an introduction for the entire session, of which it will not be of any importance. But understanding that what is EPS, it's all about the profit attributable to ordinary shareholders at the end of each reporting period. Then the next thing you need to know is all about types of EPS, basic EPS, diluted EPS. Then the next thing you need to understand, how do you do this basic? Powers of our nose. Powers in profit attributable to ordinary shareholders. Then one knows it's all about the weighted average number of ordinary shares. Then the main thing is all about how do you determine your powers. Now, once you understand that it's all about reported profit after tax, you raise the profit attributable to non-controlling interest. Non-controlling interest, these are minority shareholders in an entity. Then you raise the preference dividends. And those are mostly the three items you will find in any question. The first three. The reported profit after tax, profit attributable to the non-controlling interest, and the preference dividends. That is the things you could find in a question. In some scenario, you can find extraordinary items. Then one knows the weighted average number of ordinary shares. It's all about the number of ordinary shares weighted for time factor. The number of ordinary shares. I have not said preference. I have not talked about another shares, but I've said ordinary. You weigh as per the time factor, which I say you consider from the time when they were issued. So if they were issued on July, when you are weighing, you multiply with the month from July to the end of the year. That is how you do weighing. So if the shares were outstanding for the entire year, you consider for the entire period times 12 out of 12. Then I have said that there's this aspect of issue of shares whereby the entity issue the common shares. Common shares are ordinary shares. So common shares are ordinary shares. So whereby an entity issues shares without a corresponding change in resources. So this is what I've talked about, like bonus. So bonus I've said is whereby the entity gives shares to the existing shareholders at no consideration. That is for free. So in this scenario, again, remember that it has to affect your nose because it's shares which were issued. So to the existing shareholders at no consideration on a certain proportion. So what are you supposed to do with the one nose? So the shares which are created, that is, which were issued through the bonus, you weigh those shares from the earliest reported period. So from the date when such shareholders were entitled to the dividends. So when I would be coming to do an illustration is when you will understand this more. What I mean when I say you weigh the shares from the earliest reporting period, that is from the date when the shareholders were entitled to the dividends. So for now, know that these shares are weighted from the earliest reported period. A good example anyway, before even I go to the exam illustrations, is whereby, let's say, there was shareholders in an entity, whereby the entity had already issued around 200,000 ordinary shares, and these were outstanding for the entire year. Then coming to September, the entity did a bonus on a certain proportion. So remember that obviously, in order to determine the bonus this entity made, you have to take that proportion, you equate with the number of ordinary shares which were there from the initial period. You determine the bonus. So I can see that Isabella, you have a question.
Examples like extraordinary items ni kama gani?
So you are talking about So I've said that like now this aspect of right issue, I think I've mentioned about it. That is another thing you need to know how to deal with. That one is okay. Then share split. So to start with, let us check a question of 2013 December 2013. So December 2013. So December 2013. So this is the question. So they say that the capital structure of Yamaha Limited as at 1st March 2012 was as follows. So we have 6 million ordinary shares of shillings 5 each. We have 2 million 10% cumulative preference shares. We have 12% convertible bonds. Then we have additional information. The additional information here, they say that during the year ended 31st March 2013, the company reported a profit after tax of 85.6. Then on 1st May 2012, the company issued 1.5 million ordinary shares at full market price. On 31st August 2012, the company made a right issue of 1 ordinary shares for every 4 ordinary shares held on that date. The exercise price was shillings 36 per share, and the come right price on the last quotation was shillings 48 per share. On 1st January 2013, holders of shillings 10 million 12% convertible bond exercise their conversion right. So each 10,000 of the bond is convertible into 250 ordinary shares of shillings 5 each. On 1st January 2013, the employees of the company were granted share options to purchase 1 million ordinary shares of shillings 30 each. The average market price was shillings 48 per share. As at 1st March 2013, none of the employees had exercised their options. So the corporation rate, that is the corporation tax rate, is 30%. Then you are given the basic earnings per share and the diluted earnings per share. So that is what is required to be done. So the basic and diluted. So for the basic earnings per share, you know it's all about the profit attributable to ordinary shareholders. The profit attributable to ordinary shareholders, you divide with the weighted average number of ordinary shares. Then when I will come to the part of diluted, and that one I will be required to introduce the diluted before we do that question. I will be required to introduce that part of diluted. So, but now let us start from the basic earnings per share. We do it very fast. Then I will introduce diluted. Then again, I can be able to do the diluted so that you can say at least you have an idea on how to do the first question for the earnings per share. So let us now add to our whiteboard so that we can be able to tackle that question. So for this question now of 2013, the question of 2013, so where we are supposed to start with is the determination of PAUS. So which we know that for the PAUS, which is the profit attributable to ordinary shareholders, because we have said basic earnings per share is all about the profit attributable to ordinary shareholders, you divide by with the weighted average number of ordinary shares. So whereby the PAUS is all about the reported profit after tax, the reported profit after tax. Then after the reported profit after tax, remember you are supposed to raise the profit attributable. That is the profit attributable to NCI. So after the profit attributable to NCI, remember these are minority interests. You are supposed to raise the preference. You are supposed to raise the preference dividends. You raise preference dividends. Then you add and you raise add stroke less extraordinary items. This is the formula. Extraordinary items. So the extraordinary are items. So let us check now what we have in our question. The profit after tax, was it available? Profit attributable to NCI, was it there? Was there preference to dividend was there dividends to preference shareholders? So to start with, you can see like now here, they said that the capital structure of Yamaha as at 31st March 2012 was as follows. Remember that what makes up a capital structure in an organization is ordinary shareholders, preference shareholders, and loan note holders. Loan note holders, like now the bond holders. So these are the providers of capital in an organization. These are the guys who makes up an organization. Like now, if you want to be part and parcel of a certain company, you go and buy shares. So you can buy preference shares or ordinary shares. And you know that when you have a share of an entity, you are part of the owners of that entity, because a share is a unit of capital in an organization. So when you have a share, you are like now you are part of the owner of that entity. You have even if you don't have a say, you contribute. You contribute something to the organization. So that is fine. So what I was looking for is the profit after tax to start with. So that is why the first thing they said during the year, that first March 2013, the company reported profit after tax of shillings 85.6. So that is the case we have here. So 85.6. So that was the profit after tax. Then we have the profit attributable to NCI. Was it present in the question? Was it present in the question? So there was no profit attributable to the NCI in this question. So then the next thing I have to check is the dividends which are attributable to the preference shareholders. So what you do, you check where we have the preference shares. Like now, at the start of the year, because this balance you are given here is as at 31st March, which means that there will be the opening. Because our financial year, if you can check here at the required, our financial year, the items you are supposed to compute is as at 31st March 2013. So, which means that as at 31st March 2013, which means that our financial year starts on 1st April 2012. And what we are given in this capital structure is as at 31st March 2012, which means that it's just one day. So, which means that these were balances for the previous year. These are the balances for the previous. So, I mean that it's one day to the next financial year. So, these were the balances which were closing the previous financial year. So, which will be the opening for the current year now. So, you can see you have a 2 million 10% cumulative preference shares. 2 million 10% cumulative preference shares. So the total is 20. So out of that, the preference dividends are dream. Let's say that the total value of the preference shares is 20 million. And you have a certain rate there. So the dividends which would be paid out of this figure you are given here is, so the dividends which the entity will pay is what? The entity will pay?
Is it 10% of the total amount?
Yes, the 10% of the total amount. So which means that is 2.
Yeah.
Yes. So this one will be 20 times 10%. So this one will be 2. So this one was not there. There was no profit attributable to the NCI. Then even this one was not there. So these two are not there. So which means that my profit attributable to ordinary shareholders, this one means that way. The profit attributable to ordinary shareholders is So these are about 83.6. 83.6. That is 83.6. So let me get one-off. So what about the one-off? The weighted average number of ordinary shares. So the main thing you need to ask yourself in this question, is there a bonus? To make the question easier for you, is there a bonus issue? Is there a right issue? Is there a share split? Or is there a reverse split? A reverse split. So in this question, so in this question, the only thing which was there is this aspect of right issue. Because now once I read the question the first time, I think I identified that there was a right issue. And when this aspect of right issue, this is how you are supposed to get your one-ons. When there's this aspect of right issue. So you write the formula, which is ordinary shares before right issue. Ordinary shares before right issue. Ordinary shares before right issue. Then what you do, you multiply with the fair value. Fair value before right issue. Fair value before right issue. You multiply with the period before. So you say period before right issue. So you say period before right issue. So after doing the period before right issue, after getting your answer from that scenario, what you are supposed to add with ordinary shares after right issue, after ordinary shares after right issue. You multiply with the period after right issue. The period after the right issue. So that is what you are supposed to do. So that we have to do the analysis of shares. Analysis of shares in this question before I do the presentation. So I say that there's a right issue because of this statement here. Because of this statement in this scenario. So there's this statement here. That is additional information number 3, because they say that on 31st August 2012, the company made a right issue of 1 ordinary shares for everyone. That is it made a right issue. So we have said that on 31st August 2012, the company made a right issue of 1 ordinary shares for every 4 ordinary shares held on that day. For every 4 ordinary shares held on that date. The exercise price was 36 per share, and the come right price on the last quotation was 48. So what you need to know is that I say the right issue is whereby the entity issues shares to the existing shareholders at a lower price than the existing market price. Like now here you can see the entity issued shares on a certain proportion to the existing shareholders at a lower price, which is 36, which is this 36, because the exercise price was 36. The exercise price was 36. And the come right price, which is the market price, the come right price on the last quotation was 48. So this is the statement here, which gives us the explanation of a right issue. So the issued shares are 36 instead of 48. So it means that the market value was 48 and the entity issued shares are 36 on a certain proportion. This proportion is the one in which you are given here. 1 ordinary shares for every 4 shares held. So for every 4 held, you were given 1 at 36. shillings instead of 48. That is why, in order now to determine my one knows, I have to use the formula, which I have written in the whiteboard. So before I use the formula, I need to do analysis of all the ordinary shares which were issued by the entity in this period. That is for the entire year, starting 1st April 2012, ending 31st March 2013. So to start with, remember that our financial year was starting on 1st April 2012. That is what we have seen according to the timing you are given. So we have to write here date, details, then we have shares. Date, details, and shares. So our financial year starts 1st April 2012. So 1st April 2012, do we have any ordinary shares? Remember that under one nose, you are not dealing with any other shares other than the ordinary shares. We call them again the common shares. In some scenarios, we call them common shares. So the ordinary shares, so you can see the capital structure of Yamaha as at 31st March 2012 was as follows. So as at the start, so this was the start of the year, 31st March. So after that 31st March, you know that you move to 1st April. So that is the start of the year. So you have 6 million ordinary shares. 6 million ordinary shares. And remember that when we are doing one nose, the weighted average number of ordinary shares, we weigh the number of ordinary shares. Number of ordinary shares. We don't deal with the value like now that we deal with the number of ordinary shares. So which means that on this case, I have to weigh the 6 million for the entire period because that it was from the start of the year. So the details is all about the balance brought down. So the number of ordinary shares I have here is 6. So I cannot go forward to weigh because this aspect of right issue, you apply the formula. That is why I have written the formula. Then I get the shares which I will apply under the formula. So what I'm doing is just the analysis of shares. So there was 6 million shares which were existing from the start of the period. So I have to check another shares which were I have to check another ordinary shares which were issued. Note 2, because note 1 was concerning profit. Note 2, they said on 1st May 2012, the company issued 1.5 ordinary shares at full market price. So again, the company issued 1.5 ordinary shares. So this is a new issue, which was done on 1st May 2012. On 1st May 2012. So this was a new issue. This was 1.5. Then after that, we go to additional information number 3. Again, there were some shares which were issued through a right issue. Some shares which were issued through a right issue. So number 3, they say that on 31st August 2012, the company made a right issue of 1 ordinary shares for every 4 ordinary shares held. So we need to get how many shares the entity issued through the right issue. So the proportion was 1 for every 4 shares held. And this one happened on 31st August 2012. This one took place on 31st August 2012. So this one was a right issue. So right issue is very simple. So for every 4 held, they were getting 1. How many shares were held by this time? By August. So by August, these are the shares which were held, the 7.5. So the one from the start and the new issue which was made on 1st May. So that is what I'm getting, 7.5, 7.5. It's the same as saying 1/4 times 7.5. So after you equate this way. So if you take a quarter of 7.5, what are you getting? A quarter of 7.5. So 7.5 divided by 4.
1.87.
1.875. So let us again check. Let us again check if there is another ordinary shares. Let us check if there is another ordinary shares which were being. Let us check if there was another ordinary shares which were issued. So because we are done with about up to additional information number 3. Additional information number 4. We can see on 1st January 2013, holders of 10 million, 12% convertible bonds exercised their conversion right. Each 10,000 of the bond is convertible into 250 ordinary shares of shillings, 5 each. So you can remember that from the start, our capital structure was containing even a bond of. So this bond was it was a bond of 25. It was a bond of 25. But now out of the bond of 25, 10 million converted. Remember, it was 25 million. 10 million converted to ordinary shares. Because now under our nose, I'm dealing with only the ordinary shares. I don't consider bonds. I don't consider preference shares. So I have to check on which way did they convert to ordinary shares. So when I will be going to diluted earnings per share, I will tell you that under diluted, we always use securities which are likely or unlikely to be converted to ordinary shares. Under diluted earnings per share, we use the securities which are likely or unlikely to be converted to ordinary shares. And examples are convertible bonds or debentures, convertible preference shares, share options, and warrants. So those are some of the securities to use when we are doing diluted. So which means that this convertible bond will be part of our security when I will be doing my diluted earnings per share. But it will only be considered under one nose because part of it was specifically converted to ordinary shares. They said that under note 4, on 1st January 2013, holders of 10 million, 12% convertible bonds exercised their conversion right. So each 10,000 of the bond is convertible into 250 ordinary shares. And remember that under our nose, we weigh ordinary shares. So we have to do a cross multiplication using this proportion. So 10,000 of the bond is equal to 250 ordinary shares. What about the 10 to get the ordinary shares? So it was 10,000 of the bond is equal to 250 ordinary shares. So what about this 10 million? Remember that it's 10 million, so we have to reduce it to millions. Our question was in terms of million. What about that? So we have to cross multiply. And this one took place when? This one happened. When did they carry out this aspect of conversion? On 1st January, that is according to note 4. On 1st January 2013. On 1st January 2013. So I have to write here 1st January 2013. So 1st January 2013, we say conversion of bonds. So the conversion of bonds. So conversion of bonds. So we say 10 times 250. 10 times 250 divided by 10,000. Divided by 10,000. So that you determine the relevant ordinary shares. So conversion of bonds to ordinary shares. Remember that is what I'm looking for. So if I divide, I'm getting 0.25. So these are the relevant ordinary shares which they converted to 0.25. So getting that 0.25, that is okay. So again, we need to check if there is another ordinary shares which was there, which would be applicable in our formula. So note 5, they say that on 1st January 2013, the employees of the company were granted share options. So I cannot continue reading that because I can see it's share options, which was granted to the employees. It's just a privilege which is given to the employees to purchase the shares at a lower price. So at a certain price than the average market price. But this one can never be used under the weighted average number of ordinary shares. Under the one-ons, you can never use share options. So I said that when I will be doing my diluted earnings per share, under diluted earnings per share, we use the security which are likely or unlikely to be converted to ordinary shares. The one which are likely or unlikely to be converted. We call them potential securities. The securities which pair the word convertible. Securities which pair the word convertible, including these share options. Which are these securities? I said potential securities. Which are these securities? We have convertible bonds or debentures, convertible preference shares, and these share options. So I dealt with the convertible bonds under one-ons because they said that some of the convertible bond was converted to ordinary. Specifically, they said that 10 million was converted. That is why I dealt with that case. But if none was being converted, that one could have been used under the diluted earnings per share. So which means in short, note 5 can never be used under one note. That one is applicable under the diluted earnings per share. Beside the other potential securities, the one which are likely or unlikely to be converted to ordinary shares, which are convertible bonds or debentures and the convertible preference shares. Even if they say convertible, they are likely or unlikely to be converted. We have to deal with them under the diluted earnings per share. So once we have done the analysis of the ordinary shares, so the next thing I will do is now to apply this relevant ordinary shares in my formula to determine the one-nos when there's this aspect of right issue. So what we are supposed to do is just the application of what we have done concerning the analysis of shares in our formula. So you remember our formula very well. It was ordinary shares before the right issue. Ordinary shares before the right issue. So the right issue was in August. So the right issue occurred here in August. So which means that the period before the right issue, we have 7.5 ordinary shares because the 6 plus 1.5. So that is 7.5. Then the fair value was 48. You divide with the theoretical exercise price. So this one, I will show you on how to get it. Then you multiply with the period before. So the 48 is that price which was higher than the exercise price. They call it the come right price on the last day of the quotation. That is how they called it for this question. So that is the fair value. And those prices, you just pick them direct from that statement whereby they mentioned this aspect of right issue. So this is the case, the one which is bolded. So we said that the exercise price was 36 per share and the come right price on the last quotation was 48. So the 48 is the fair value, which is the market price. Theoretical exercise price, I have to do a calculation. Then period before right issue. Period before right issue. Remember that our month, our year, our financial year ends 31st March 2013. It ends 31st March 2013. It was starting on 1st April 2012. Our year was starting on 1st April 2012. So the period before right issue. So, and the right issue was on 31st August. 31st August 2012. So the period before, how many months are those? So it's all about April, May, June, July, August. So these are 5 months. So 5 months. So 5 over 12. Then you multiply, you add, not you multiply, you add with ordinary shares after right issue. So the ordinary shares after right issue is the shares which are before the 7.5. You add with, so the 7.5 you add with the ordinary shares which were through right issue. That is how you get the ordinary shares after. So it's like now the one which were before the 7.5 plus the one which was through the right issue. The shares which they issued when they made a right issue, the 1.875. So you pick 7.5 plus 1.875. So that is 9.375. Then period after is 7 over 12. So the 7 over 12. So what I'm remaining with is all about how to get the theoretical X-right price. That is the TRP, theoretical X-right price. So this one, it has a formula, but I always ignore that formula. I always ignore that formula, and I will give you a shorter way on how to get it. So what you do, you check the proportion. So you say the proportion was 1 for 4 held. That was the proportion on how they made the right issue. So for every 4 shares which were held by shareholder, the shareholder was getting 1. So the shareholder was getting 1 at 36 shillings. And the market price, which is the fair value, was 48. Was 48. So you can see the shareholder was getting the share at a lower price, than the existing market price. So what you come and do here, you say the one new is at what price? 36. The one new is at 36 because now the one new share the shareholder is getting through the right issue is at a lower price, which is 36. Then you say therefore all at 48. Therefore all at 48. Because now the one which were held from initial, they will be at a market price. They will be at a market price of 48. So 1 times 36, that is 36. 4 times 48 is, this is 192. So what you do, you add these two. So 1 plus 4 is 5. Then 36 plus 192. This one is 228. So what you do, you divide the two. 228 divided by 5. So you divide by 5. So you get 45.6. So which means that here is 45.6. So 45.6 is our theoretical X-right price. The theoretical X-right price. So that since that is a theoretical X-right price, we can be able to determine our one-nos. Because now it's just putting the figures in the calculator. So if I say 7.5, I multiply with 48, I divide with 45.6. You multiply with 5 out of 12, you close, you add a 9.375, you multiply 7, you divide with 12. So what are you getting? What are you getting? So this is 8.76. So what you can see is that what we have done, we have applied these shares up to this point in our formula. So again, there is these shares which were issued. Remember, these are the shares which were being present. They were never issued, but they were generated through the conversion of a bond, the 10 million. of the bond was converted, and they got these 0.25 ordinary shares, and that one was on 1st January 2013. So when these just the shares and they have not affected our formula. So for example, now if you could have been given these shares, the 0.25, and you are told determine one was, for example, you are given now these shares 0.25, you are told determine one was. There is no right issue in that sitting, there is no anything. You are just given the ordinary shares. So what you always do, you weigh those shares. So you take 0.25, you weigh them from the period which they were issued, you consider to the end of the year. So remember that it was January 2013, it was January 2013. So from January 2013 to the end of the year, those are 3 months. So 3 over 12. Because it was January to end of March. So you just weigh them because they were never affecting our formula. They were never affecting our formula, but it was the ordinary shares which were present in that relevant financial year. They were present in that financial year. So you weigh them by just multiplying with the period. That is from that time when they were converted to the end of the year. So this one is 0.0 something. 0.0625.
625.
So add it to 8.76. So this is 8.82. 825. So up to this scenario, we can be able to conclude that we can be able to say that our basic EPS, our basic EPS is equals to powers of our nose. Powers, we did it, the profit attributable to ordinary shareholders. We got which figure?
Uh, 83.6.
So it's a 3.6. So you take it 3.6, you divide with 8.8225. So we say shillings worth per share. We say 9 point. That is shillings 9.48. So that was 9.48 per share. So the 9.48 per share. So to talk about the diluted earnings per share, we have to talk about this aspect of what securities you are supposed to use. So which I have said that you use potential securities. So the securities which bear the word convertible. So they are easily converted to ordinary shares. So initially I said that yes, they are potential securities, but they are securities which are likely or are unlikely to be converted to ordinary shares. So remember that under basic earnings per share, we only deal with common shares, that is ordinary shares, or some of these potential securities, but the one which was specifically converted. Out of the potential, you deal with the one which are specifically converted. But under diluted, you can deal with the one which are converted or the one which are likely to be converted. And those securities are convertible debentures, loan stocks, or bonds. We have convertible preference shares, share options, or warrants. So what are the steps are you supposed to follow? So what are the steps are you supposed to follow? So step one, you always compute basic EPS. Like now the one, that is why, like now here in our question, that is why the first requirement was basic earnings per share. So after you are done with the basic earnings per share, you determine the order of ranking the securities. After you have determined the order of ranking the securities, you compute now the diluted earnings per share based on the ranks in step 2 above. You compute the diluted earnings per share based on the ranks in step 2 above. So that is the case. So let us finish our question. Let us finish our question. So the first step we are done with it, because you can see we are done with the basic earnings per share. So the next step we need to do is now to determine the order of ranking the securities. Then once we determine the order of ranking the securities, we can use now the length to compute our diluted earnings per share. So to make the equation simpler for you, I will be able to show which are some of these potential securities do we have in our equation. Among the convertible bonds, debentures or loans, convertible preference shares, share options or warrants, what do we have in our equation? We have only 2 items here because we have the convertible bonds. You can see them even from the start of the equation. The 12% convertible bond, this 12% convertible bond. So the total was 25. Even if they converted 10, remember that under diluted, we deal with both, the one which are likely or unlikely to be converted. But under basic, we dealt with only the one which they converted. But now under diluted, we deal with the total, the 25. That is the first security, the 12% convertible bond. Then there was another one in number 5, the share options. Because they said on 1st January 2013, the employees of the company were granted share options to purchase 1 million ordinary shares for Shilling 30 each. The average market price was 48 per share. As at 31st March 2013, none of the employees had exercised their options. The corporation tax rate is 30%. Which means that we have only 2 potential securities. So what you do, you determine the order of ranking the securities, and you rank from the risk. The risk security which has a risk effect to the diluted earnings per share, to the basic earnings per share, not the diluted. The one which has a risk effect to the basic earnings per share. So we have so determine order of ranking the securities, order of ranking the securities, order of ranking the securities. So the order of ranking these securities, you could have around 3 columns, if not 4. The first one is those potential securities, is the potential securities. That is the first column. So after the potential securities, you have what we call incremental.
Mbona sioni screen yako?
So we have 4 columns, that is potential securities, incremental earnings, incremental shares, earnings per incremental shares, then we rank. So already we have seen the potential securities which we have, whereby we have the bonds and we have the share options. So why do I have this incremental earnings and incremental shares column? Let's say, for example, the entity has issued the preference shares, the convertible preference shares. So if this security will be converted to ordinary, remember that initially the return which this entity was supposed to pay to the preference shareholders was concerning dividends. But now, since the security is converted to ordinary shares, the entity will never pay the dividends. So which means that the entity will make a saving. That is why there will be an increase in earnings. Then since now this security will be converted to ordinary shares, again there will be an increase in incremental. There will be an increase in terms of ordinary shares. That is why we have a column of incremental shares. That is the perspective whereby you are supposed to perceive these two columns from. At the same time, it's like now the debenture. If a debenture is issued, the entity was supposed to pay interest. But now it will never pay the interest if the security is converted to ordinary share, which means that there will be a saving in terms of this interest. It will never pay. That is why there will be an increase in earning. Since this security is converted to ordinary shares, remember that again, ordinary shares will increase. That one will give us the incremental earning column. Never forget that under earnings, we have to apply the aspect of tax shield, whereby a security which was issued, the return from that security is interest. And remember that now, since this security is being converted to ordinary shares, this interest was never paid. So there's that aspect of a saving which was made in terms of interest. So again, out of that, we have to apply a tax shield of 1 minus t. That is why in the additional information in that question, you were given a tax rate of 30%. So let us start with the first thing you are told here. The first potential securities you are given. That is what note 4. That is what they converted. The total security was 25. The 12% convertible bond. 12% convertible bond. 12% convertible bond. So the 12% convertible bond. So the under earnings, you have to do this way. Remember that out of the 25, 10 was converted. 10 was converted. 10 was converted to ordinary shares. But I say that when we are dealing with diluted earnings per share, we use both securities. The one which are likely or unlikely to be converted to ordinary shares. So what I'm supposed to do on that scenario, I would just recognize both of them by starting with the column of incremental earnings. By starting with the column of incremental earnings. So whereby, remember that the percentage was 12. So I will say 12%. I will say the 12%. We multiply first the 10 million. The 10 was the one which was converted out of the 25. So this period was, they converted this 10 on which period? So we have to consider first up to the date of conversion. Remember, I'm talking about this question here. The total was 25, the 12%. But now, under note 4, they said on 1st January 2013, holders of 10 million, 12% convertible bond exercise their conversion right. So remember that under diluted, we have to deal with both the 25. But I will deal with first the converted, then the unconverted. Because I said I deal with this potential securities which are likely or unlikely to be converted to ordinary shares. So the 10 was converted on 1st January. So I have to consider up to the 1st January. And our financial year was starting on 1st April. So from 1st April 2012, because it was ending 31st March, our financial year was ending on 31st March 2013. So it was starting on 1st April 2012. And this conversion of 10 million of the 25 occurred on January. It occurred on January 2013. This one took place on January 2013. So which means that these are 9 months, these are 3. So up to the time of conversion, this one is times 9/12. times 9 over 12. Then I said, if the return from the security was interest, and remember that this aspect under this security, it is converted to ordinary shares. So this interest can never be paid. This interest was never paid. So there was a saving which was made. That is why we need to apply a tax shield of 0.7 here, because this is 1 minus t. T you are given, t is tax, 1 minus 0.3, 0.7. So you apply only the 0.7 under the earnings. Then I have to add with the 12% of now the 15 times 12 over 12 times 0.7. So remember that I'm saying 15 because the total security was 25. By January, they converted 10. So I have considered the 10 for 9 months. Remember that the 15, which was never converted, was there for the entire period, because this one was there from initial. That is why I'm saying 12% of 15 times 12 over 12 times the tax shield of 0.7. That was concerning earnings. Then incremental shares, this one is again very simple. So for incremental shares, what you do, it's all about the proportion which was used when they were converting. Remember, it was for every 10,000, they were converting to 250 ordinary shares. That is the proportion which we were given in the additional information. That is the proportion which was provided in the additional information. So each 10,000, so this is not 4, there are sentence, each 10,000 of the bond is converted into 250 ordinary shares of shillings 5 each. Of shillings 5 each. So the first thing they converted 10. They converted 10. So what about that? So that is what I will say 10 times 250. You divide by with 10,000. Divide with 10,000. So the period remains to be the 9 months because it's up to the time of conversion. Then after getting your answer there, you have to add. Now it will be 15 times 250 divided by 10,000 times 12 over 12. Remember, the 15 is the one which was unconverted. The 15 was unconverted. So up to that point, which answers are you getting for the first one and the second one? Earnings and the shares. Then if you have a question again, you can ask. So the first one, I'm getting 1.89, and the second one, that is under incremental shares, 0.5625. So to get this column now, earnings per incremental shares, you divide the two. So 1.89, you divide with 0.5625. So that is 3.36. That is 3.36. Then finally, we can do now the last part of the question. So the potential security again, which was there, is concerning the options. Under options, obvious earnings is 0. The earnings is 0 because nobody would exercise. There's nobody who would exercise these options which they were given. Number 5, on 1st January 2013, the employees of the company were granted share options to purchase 1 million ordinary shares of 4 shillings 30 each The average market price was 48. The average market price was 48 per share. As at 31st March 2013, none of the employees had exercised their options. So none would exercise. That is why the earnings is 0. What about incremental earnings? What if now they exercise? What could have been the benefit? What could have increased? How could their shares increase? So remember that they were given an option to purchase some 1 million. It was 1 million shares at a price of, it was at a price of 30. But the market price was 48. So which means that they could have gained at 18. They could have gained 18. So what do? We always equate 1 million is equal to the market price of 48. What about 18? 18. So take 18 times 1 over 48. Then getting that, you get the number of shares they could have gained with. You weigh from the period they were given that option. From the period they were given that option. So in short, this is what you are supposed to do. So under this, I will take my 1 million. So the 1 million is the option. I will multiply. So the 48 minus 30. 48 minus 30. You divide by with 48. That is the same thing I have equated with when I was explaining. Then after getting your answer, you weigh now from the period when they were given the option. So the period when they were given the option was, the period they were provided the option was on 1st January. So from January to the end of the year, which is that 1st month, is 3 months. So from January to the end of the year, so 3 out of 12. 3 out of 12. So that is 18 divided by 48 times 1 times 3 over 12. That is 0.094. So 0.094. So if you divide the two, obviously it will be 0. Then you rank from the risk. So this is the risk, the one which has a risk effect to the basic earnings per share, because it's the one which is 0. Then this is number 2. Then after you have ranked, you will come and compute. Now compute diluted earnings per share using the ranks. So use the ranks to compute the diluted earnings per share.
How are we ranking? I thought the 3.36 should be the first one.
You rank from the risk.
Oh.
The 0.
Sawa.
So these are about what you draw. Now we compute diluted earnings per share here. So we have earnings, shares, and diluted earnings per share. So you start from what you have, from basic earnings per share. So our earnings was pounds, shares was 1 ounce. Shares was 1 ounce. So there was a pause of 83.6. So this one, the 83.6, and this one was 8.8225. So we were getting 9.48. That is what you copy from the first step. So the pause 1 ounce and your basic EPS. Then you come here and pick the first one. The first one is an option. It's an option. So you pick the earnings. Earnings is 0. And the shares is 0. So this is 0. And this is 0.094. So you add. You get it to 3.6. And the other one is, so 8.8225 plus 0.094. So this is 8.9165. So you divide the two. 83.6 divided by answer. To get 9.38. 9.38. Then the second one was concerning convertible bond. So convertible bond, so 1.89, so this one. And we have a 0.5625. 0.265. So 83.6 plus 0. Not 0. But 1.89. So this is 85.49. Then the other one is 8.9. 8.9165 plus 0.5625. This is 9.479. So you divide the two. 85.49, you divide the answer. So you get 9.01. It's 9.02. 9.02. So we can conclude that diluted earnings per share is equal to shillings 9.02 per share. So you pick the risk. And that one marks the end of the question.